Hello everyone. Today we will learn about the leverage ratios. The leverage ratios, also referred to as solvency ratios or gearing ratios, measures the company's ability in the long term to sustain its day-to-day operations. Leverage ratios measures the extent to which the company uses the debt to finance growth. Remember, for the company to sustain its operations, it has to pay its bills and obligations. Solvency ratios helps us understand a company's long-term sustainability, keeping its obligation in perspective. We touch upon the topic of financial leverage while discussing return on equity and the DuPont analysis. The use of leverage is like a double-edged sword. Well-managed companies seek debt if they foresee a situation where they can deploy the debt funds in an environment which generates a higher return in contrast to the interest payments the company has to make to service its debt. Do recollect a judicious use of debt to finance assets also increases the return on equity. However, if a company takes on too much debt, then the interest paid to service the debt eats into the profit share of the shareholders. Hence, there is a very thin line that separates the good and bad debt. Leverage ratios mainly deal with overall extent of the company's debt and help us understand the company's financial leverage better. We will be looking into the following leverage ratios: interest coverage ratio, debt to equity ratio, debt to asset ratio, financial leverage ratio. So far, we have been using Amar Raja Batteries Limited (ARBL) as an example. However, to understand leverage ratios, we will look into a company that has a sizable debt on its balance sheet. I have chosen Jain Irrigation Systems Limited (JISL). I would encourage you calculate the ratios for the company of your choice. Interest coverage ratio. The interest coverage ratio is also referred to as debt service ratio or the debt service coverage ratio. The interest coverage ratio helps us understand how much the company is earning relative to the interest burden of the company. This ratio helps us interpret how easily a company can pay its interest payments. For example, if the company has an interest burden of Rs 100 versus an income of Rs 400, then we clearly know that the company has sufficient funds to service its debt. However, a low interest coverage ratio could mean a higher debt burden and a greater possibility of bankruptcy or default. The formula to calculate the interest coverage ratio is earnings before interest and tax divided by interest payment. The earnings before interest and tax EBIT is EBITDA minus depreciation and amortization. Let us apply this ratio on Jain Irrigation Limited. Here is a snapshot of Jain Irrigation's P&L statement for the FY14. I have highlighted the finance cost in red. We know EBITDA is equal to revenue minus expenses. To calculate the expenses, we exclude the finance cost and depreciation and amortization cost from total expenses of 5730 crores. Therefore, EBITDA is equal to 5828 minus 5058. Therefore, EBITDA is 769 crores. We know EBIT is equal to EBITDA minus depreciation and amortization. That is equal to 769 minus 204 is equal to 565 crore rupees. We know finance cost is 467 crores. Hence, interest coverage is 565 divided by 467 is equal to 1.209x. The x in the above number represents a multiple. Hence, 1.209x should be read as 1.209 times. Interest coverage ratio of 1.209x suggests that for every rupee of interest payment due, Jain Irrigation Limited is generating an EBIT of 1.209 times. Debt to equity ratio. This is fairly straightforward ratio. Both the variables required for this computation can be found in the balance sheet. It measures the amount of total debt capital with respect to total equity capital. A value of 1 on this ratio indicates an equal amount of debt and equity capital. Higher debt to equity more than 1 indicates higher leverage, and hence one need to be careful. Lower than 1 indicates a relatively bigger equity base with respect to the debt. The formula to calculate debt to equity ratio is total debt divided by total equity. Please note, the total debt here includes both the short-term debt and the long-term debt. Here is JSIL's balance sheet. I have highlighted total equity long-term and short-term debt. Total debt is equal to long-term borrowings plus short-term borrowings. That is equal to 1497 plus 2188 is equal to 3686 crore rupees. Total equity is 2175 crore rupees. Thus, debt to equity ratio will be computed as follows: 3686 divided by 2175, that is equal to 1.69. Debt to asset ratio. This ratio helps us understand the asset financing pattern of the company. It conveys to us how much of the total assets are financed through debt capital. The formula to calculate the same is total debt divided by total assets. For JSIL, we know the total debt is 3686 crore rupees. From the balance sheet, we know the total asset is 8204 crore rupees. Hence, the debt to asset ratio is 3686 divided by 8204, that is equal to 0.44. This means roughly about 45% of the asset held by JSIL is financed through debt capital or creditors. Needless to say, higher the percentage, the more concerned the investor would be, as it indicates higher leverage and risk. Financial leverage ratio. We briefly looked at the financial leverage ratio in the previous video when we discussed about return on equity. The financial leverage ratio gives us an indication to what extent the assets are supported by equity. The formula to calculate the financial leverage ratio is average total asset divided by average total equity. From JSIL's FY14 balance sheet, I know the average total asset is 8012 crore rupees. The average total equity is 2171 crore rupees. Hence, the financial leverage ratio, or simply the leverage ratio, is 8012 divided by 2171, that is equal to 3.68. This means JSIL supports rupees 3.68 units of asset for every unit of equity. Do remember, higher the number, higher is the company's leverage, and the more careful the investor needs to be. Today, we have completed leverage ratios. In next video, we will learn about operating ratios.